Good afternoon, ladies and gentlemen. Thank you for taking the time out of your busy schedules to join the webinar today as we discuss the various problems facing expats in Belgium with regards to tax. This event has been coordinated with the American Club of Brussels. They recently celebrated their 100-year anniversary. We definitely encourage you to follow them and attend some of their wonderful upcoming events. The presentation will begin shortly. I will be the moderator of the webinar alongside our panelists of guest speakers who I'll be introducing shortly. We'll be putting everyone on mute if they're not already as soon as the presentation begins, but please feel free to ask any questions in the chat and we'll do our very best to answer them for you or interrupt the speakers to get their thoughts on the matter. Just before we start, a few disclaimers to go through for compliance reasons, so just bear with me. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. So be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. So with that, so we have a couple of our panelists here with us today. And so if you've been to our events before, you'll probably be familiar with them. So on the one hand, we have Brian Dunhill, who I'm sure many of you are familiar with before. So he's my boss, so I'll try my very best not to say too many harsh words about him, at least not while he's here. Feel free to hang around after. So he is a financial planner with a core emphasis on concentrated positions and retirement planning for expatriates. He is, of course, also the director for Dunhill Financial. Shannon Meyer is a licensed certified public accountant. He has 22 years of experience in U.S. entity and individual taxation, specializing in international tax reporting and planning for U.S. citizens residing abroad, as well as foreign nationals working in the U.S. So that's enough of hearing my voice. So what I'll do now is I'm going to turn it over to Brian and Shannon, and we'll just take it away from there.
I like your voice. I think you have the perfect voice to moderate these constantly. So thank you, Josh. And thanks for joining us, Shannon, and everybody coming along. Essentially, we want to make this as interactive as possible. So if you have any questions during the entire presentation, feel free to interrupt us, drop your notes in there. That is what Josh is for, to interrupt us and keep the conversation going. But it's never hard to keep the conversation going when Shannon's around. He's full of knowledge on all these subject matters, and I can't think of anything more interesting to talk about than tax right now, because it distracts us of what's going on in the real world. So day after the uneventful speech from Biden yesterday, let's talk about tax in Belgium. So Shannon, we know earned income tax rates are quite hefty in Belgium. How does it work when you're an expat, when you're an American expat in Belgium with tax in the United States? Do we have a double taxation agreement, or?
Yeah, so there is a double taxation agreement, and as well a double agreement for Social Security purposes as well. So in general concept, you're going to be paying either income tax or Social Security in one jurisdiction, but not supposed to be paying in both. Now the U.S. works on they've got kind of a dual ways to, so the U.S., well, step back a moment. The U.S. does tax you on your worldwide income, regardless of where you live at. So even though you're residing in Belgium, you're still going to have to file a U.S. tax return each year. Now, and it's reporting all of your Belgian income as well as U.S. sourced income. But the U.S. has kind of two different methods to avoid double taxation. One is the foreign earned income exclusion. That's where if you earn up to $100,000 a year, roughly, changes each year with inflation, but you can exclude that from income taxation on your U.S. return. The other option is foreign tax credits. So to the extent you pay taxes to Belgium, you can claim a credit for those on the U.S. system. Essentially what that means is you're supposed to avoid being double taxed on the same income in both locations.
That's brilliant. So if we use the credit system, can we apply it to things later on, or do we have to use all those credits in that given year?
So credits can be carried back 1 year, and if not used in the previous year, then they carry forward for up to 10 years. if you don't use them within 10 years, then they expire.
Perfect.
Now you do one thing with the credits is you actually have to keep your like credits on wages separate from credits on investment income. So that's one thing that people may be surprised. Sometimes they're paying a lot of tax on the like Belgian tax on their wages, but if they're not paying tax on investment income, they may not be able to use that wage tax against the investment tax income as a credit.
There's already our first Q&A question in here. Does this apply for dual citizens, Shannon?
Yes. Yep. The fact if one of your citizenships is the U.S., then you're subject to the U.S. taxation. The fact if you're another citizen doesn't actually kind of change the equation at all.
Once you're American, right?
Yep.
Brilliant. Okay, so we're digging in a little bit into that credit system versus the foreign earned income exclusion. It sounds to me like most times you're going to be in a higher tax bracket in Belgium than you would back in the States, right?
That's generally going to be the case, yes.
So are there many occasions where you would actually push forward to use the foreign earned income exclusion instead of the credit system?
Yeah, it's kind of a loaded question because it's never, it's always going to be
questions for you, Shannon, because
yeah, that's always good.
That's why
one of those is going to depend on your kind of your facts and circumstances. You know, I've had some clients that maybe, you know, let's say you're making $80,000 a year and you've got some maybe income from rental sources or investment income, different things. In that scenario, all of your wages get offset by the exclusion. You end up having some other taxable income for U.S. purposes, but you still have, even after the exclusion, you still have the standard deduction. So you could use that standard deduction that might wipe off your other U.S. sourced income, so you actually end up at zero taxable income. Now there's other scenarios, and I've run into this a lot with clients, probably more approaching retirement age and have large pensions. The way a pension works, and I'm sure we'll get into this, Brian, because this is kind of a topic all on its own, but the U.S. is going to tax your pensions at the time of distribution, and Belgium may actually have a lower tax rate on them. So there can be some scenarios where you're better off to take foreign tax credits instead of the exclusion, build up those credits, and then you can use them to offset, you know, kind of carry them forward and use them to offset your pension distributions when you receive them. So, you know, kind of the answer to that question is it really depends, kind of based upon your situation, timing in life. You know, situations could change, and that may change how you want to do it.
Absolutely. What a perfect answer. So with that credit system, can you actually make an IRA contribution over there in Belgium?
You can. So, and can potentially, you can participate in Belgian pension systems, or you can also still potentially, you know, participate in like a US Roth or traditional IRA account. There is, within the US tax treaty that Belgium and the US have, there is an article that essentially what it says is that if you can participate in a pension like in the US or in Belgium and get the same tax treatment that you would get on that in the other country. So effectively, if you make a deduction to a Belgian pension and it's non-taxable or deductible for Belgian purposes, you can get the same treatment on it in the US.
So in other words, you could take that 6,000 to 7,000, depending on your age, in the US into an IRA, and you could also do the 940 euros into a pension épargne, or even more so into your corporate pension. And
yeah,
they would
So you could participate in your company corporate pension and still be able to make contributions into a traditional IRA as long as you've got earned income to allow you to do that.
Perfect.
Perfect. So we have another question in the Q&A now. So Jim Schneider says, could you touch upon non-taxability of capital gains in Belgium a bit?
Okay, so my first caveat is I'm not a Belgian tax specialist. I've dealt with the Belgian system for quite a while now, but I myself am not a Belgian tax practitioner. One of the great things about Belgium has kind of at a high level, that's kind of an opposite system of the US. The US tends to have lower rates on kind of your working income or working class income, I would say, and then they tax your appreciation of assets. They apply a dividends tax, they apply capital gains tax, all those good things. Pension distributions are taxed as ordinary income. Belgium kind of takes an opposite approach. It's a great place if you're going to retire because they don't apply capital gains tax. Pensions get taxed at a much reduced rate generally. So you can have the situation where Belgium's not taxing your capital gains on sales of stocks, but the US is going to still tax it.
Gotcha. All right.
But on that income, they will still tax it on the Belgian side to offset the US side, correct?
Yeah, yeah, and dividends can be a unique one because there's kind of some special clauses about Belgium, or about dividends, where generally kind of what happens is the US gets the right to tax the first 15%. Belgium can then tax above that, which they may or may not. So you can't have the scenario, even, let's say you've got your US investment account, which I'm sure Brian will comment on, but generally you want to keep as a US citizen, you want to keep your assets based in a US account. It makes your life 1,000 times easier. But those US sourced dividends or dividends on US stocks end up still being taxable in the US under the treaty.
Exactly. And currently the rate, I believe in Belgium, is 27.6% on those dividends. So all of a sudden that can start to bite into wanting to have high dividend paying stocks and instead wanting to potentially have some lower dividend paying stocks.
Yep.
In that action to take advantage of that capital gains treatment in Belgium, the capital gains tax-free treatment. Josh, you've got a few more in there.
Yeah, we do. So Andrew Dyke asks, does your company provide services to file U.S. taxes for U.S. citizens residing in Belgium?
Yes, we do. So even though I'm based in Nebraska currently, I did, so, kind of as Josh mentioned before, I used to live in Belgium, so I know Brussels very, very well. I worked with Deloitte in Belgium, and I've continued to work kind of with Belgian taxes and U.S. citizens in Belgium for the last 15 so years now. So still can do that. Thank heavens we've got great technology that allows us to kind of interact, and I can help you no matter where I'm sitting.
Brilliant. All right. Great.
And I'll add to that they're proud members of the American Club of Brussels, and we're proud to have them as a corporate sponsor and a corporate member of the club. So
smart man with a plug. I like it.
Absolutely. As former president, I have to actually do those types of things.
All right. So question from, I think, Dana Wielgus. Company pensions in Belgium, PFIC or not PFIC?
Another one of those questions that doesn't get real simple. PFICs they're kind of one of those evil things that the IRS created that had a purpose, but pull in a lot of things that were probably not originally intended to be covered. So PFIC's a passive forward. Oh,
perfect. I'm sorry that you're answering exactly what I was going to say. Is let's first define what a PFIC is.
Yeah. So PFIC is a passive forward investment company. Original concept of them was to prevent, a U.S. person from being able to create this like holding company outside the U.S., put all of their assets in that holding company, and then, and say like in a Jersey, a tax-free jurisdiction, and to shelter that from U.S. taxation. So that was kind of the original intent and concept. The problem is the way that they define what a PFIC is. It's you kind of look at it's like an asset test, and if all of the assets or 75% or more of the assets are investments in other companies, so it's kind of like this holding fund structure rather than an operating company, then you can fall into these PFIC rules. And kind of to some degree, the unfortunate consequences is mutual funds. So like if outside the U.S., so if you've got like a CCAV or something, if you've got a U.S.-based mutual fund that holds foreign investments, no problem there. But if you're buying directly into like CCAVs or something on the European market.
I'm going to interrupt there. It's not a problem on the US side, but it doesn't conform with MiFID rules on the European side. Where I'm correcting that is because there's no punishment for not conforming with MiFID for now. Maybe there will be. So I would encourage people not to be buying US-based mutual funds, but definitely don't buy European-based mutual funds for the PFIC reasons. Sorry.
Yeah. Yeah, so so if you're buying into a European mutual fund, that's generally going to be considered this PFIC, passive foreign investment company, and essentially it gets really, I won't go into the details, but it just gets really unfavorable tax treatment, and you have to do a bunch of additional reporting because of that. Now, when you start thinking of a pension, it can get into what are the underlying assets of the pensions. The other one you always have to kind of watch out for is life insurance policies, because Europe tends to have a different concept of a life insurance policy than the US does. Like if you're buying a life insurance policy in Europe, it's generally not going to be a qualified policy for US purposes. They actually function more like an investment account. So you can also have these life insurance, there may be a life insurance wrapper on it, but underneath it, it's still kind of like a mutual fund type of holding. Those are generally going to be considered a PFIC, what I've seen. The pensions, it can depend.
For those that are going under the Belgian terms, in French, that's called branche 23, so branch 23, or in Dutch, it's tak 33. My Dutch is horrible. My French is not so good. So it's branch 23 is the vehicle. Branch 21, the fixed ones are fine because it's a fixed unit. It's the variable units that Shannon is referring to that would definitely fall into the PFIC category as well.
Yeah, okay. So, and company pensions, that's probably going to be to some degree a gray area, and the aggressiveness or the conservativeness of kind of who you're working with for a tax preparer. I generally kind of treat the pensions as not really looking through to the underlying assets, and don't treat them as a PFIC investment. But it's something that you kind of always want to look at, like each specific pension and how they've got it structured. So it's not an exact answer. It can be either way, but you can be in a scenario where it's not necessarily a PFIC.
All right, I'm going to cheat a bit on the questions because there's a follow-up one here. So if we can't buy US mutual funds or EU mutual funds, what do we do?
That's a wonderful question, and I'll jump on.
I'm going to let you take that one, Brian, because that's right in your alley.
That sounds like it's right along our alley. So I'm going to add a little bit more to that also, instead of buying EU mutual funds, you shouldn't buy EU exchange traded funds either, because those can be categorized as PFICs. So if you buy the S&P 500 on the London Stock Exchange, Shannon is still going to categorize that as a PFIC, and so it's just as bad as that European mutual fund or the UCIT or such. Now, the way that we get around this in Belgium to make sure that you can actually continue investing is we buy our investments in the US or with a broker dealer that can buy US securities. And you either buy individual stocks, individual bonds, or US ETFs. Now, the US ETFs should be MiFID compliant. Now, the interpretation that we utilize, I believe it's actually something that Deloitte wrote, Shannon's old employer, it was essentially if ETF has a KID statement, i.e. a European equivalent, then it meets all the criteria of MiFID. And therefore, as long as the company has a European and a US unit, then we can go ahead and say we're using the US unit to avoid those PFIC issues, but we're buying it for a European resident or citizen. Now, essentially, there's no punishment if there isn't one, because there's no punishments for not conforming with MiFID at this point in time, especially when there's no capital gains tax in Belgium, as Shannon was saying earlier, but that's the easiest way. A lot of you might have found out that when you move to Belgium, that the brokerage channels will not allow you to keep your account with a Belgian address. That's where our company can help you out with setting up an account and getting it invested, or if you're being pushed out of your brokerage channel, we can go ahead and transfer them into our management. We have a European license and a US license, which is why we're allowed to do so, whereas most of the big firms don't want to marry those two. So it's not that we're doing anything special, we're just licensed in both jurisdictions. Therefore, we're just like all of you. Pretty much most all of our staff are cross-border individuals that have to deal with these types of issues, and we can help you with those. I don't want to hijack this because Shannon is our special guest and we are here to talk mostly about tax, but when Josh sends the follow-up, he'll send you a full playlist, which includes our past webinars that only talk about financial planning for Americans in Belgium. And otherwise, Josh or myself will be happy to have a conversation with you on how we could help.
Exactly. Okay. So next question is, can you repeat how we know if we're eligible to purchase an IRA, Roth or traditional? Do we need to meet certain income requirements and/or have any earned income in the US, etc.?
So the first condition is you've got to have earned income to be able to make either a Roth or an IRA, a traditional IRA contribution. And so it doesn't matter, that income can be US based earned income or can be European based. So you could be working a Belgian job, have employment wages from that. That's still going to count as earned income for US purposes. And if one spouse, let's say you're married and only one spouse is working and the other spouse is not, a spouse can also borrow earned wages from a working spouse to be able to make a contribution as well. So that's kind of the first parameters. That applies to both traditional versus a Roth IRA. Now, when you start talking traditional IRA versus Roth IRA, really the difference there is the timing of the deduction. So if I use a traditional IRA, this is going to be what you kind of commonly think of like a 401k account as well. I put money into it up front. I get a tax deduction at the time I put the money in. It grows tax deferred over time. But then when I take a distribution from that traditional IRA in retirement, I'm going to be taxed at that point in time. Roth is basically the exact opposite of that. So I get no deduction up front when I put the money into the Roth account, but from then on it's tax-free. It grows tax-free. And then when I take it out in retirement, I've got no taxation on it. So it's really kind of deciding which one you want to use is kind of a decision of what's my tax break or tax bracket that I fall in now versus what do I think my bracket's going to be at the time I take out my distribution. It's pretty much as simple as that. If you run all of the math, those are the two driving principles. Now, one condition with a Roth is they do have some income limitations on Roths, on who can contribute. And it's going to vary depending upon whether you're single or married or those type of parameters, but it's usually going to be like that $100,000 to $150,000 range. If you start going over that amount, then you can't. Well, so let's say if you're below that, you can make direct contributions into a Roth, no problem there. If you're over those income levels, then you may potentially not be able to make a direct contribution into a Roth, but there is what they call a back doorway, where effectively you can make a contribution into a traditional IRA, subsequently roll it over to a Roth. That's a taxable event when you do that rollover. But if you didn't take any deduction when you put the money into the traditional IRA, you've got full basis. Effectively, your taxable income on that rollover is zero. You pay no tax on it, and now you've got your money in the Roth. And again, one of those things that I'm sure Brian can help you work through, but it is possible to get money into a Roth even if you're over the income limits. But there are some hiccups you've got to work through on that, like looking at if you've got other IRA accounts. We won't go into the details. It's something that you can do, but certainly talk to your tax advisor before you do that, because there's some things you got to work through to make sure it fits your situation.
Absolutely. I know we've worked on a couple cases where it's been optimizing the tax of getting it from the traditional over to the Roth IRA. And sometimes it doesn't necessarily need to be the answer of doing it all in 1 year, but it can be optimizing it over the course of several years to stay in a lower tax bracket.
And conversions while you're in Belgium can be a good option. So let's say that you've got a pre-existing, let's say you had a 401k account from a previous employer in the US. When you left the company, that got distributed out and that's sitting into a personal IRA account now. Well, when you're working and living in Belgium now, and you're claiming the foreign earned income exclusion, you may be excluding all of your income. Well, you still have that standard deduction to use on your tax return. You could potentially do a conversion of it to a Roth. And so taking your traditional IRA or your old 401k, convert it into a Roth, that's generating taxable income because that old 401k has no basis in it. So let's say I've got, I had a $50,000 401k that's now sitting in a traditional IRA. I convert that over. I'm going to have $50,000 of taxable income, but I can potentially offset that with my standard deduction. Now you may, in that scenario, you may want to do it over a couple of years because you could only have a $12,000 or a $25,000 standard deduction, but you may do it over a couple of years and effectively end up getting the money into a Roth without ever paying any tax on that conversion. A lot of times, depending upon the state that you previously lived in the US, if you broke state residency while you're in Belgium, you then also avoid state income taxes on it as well. So doing the conversions while in Belgium might be an interesting thing to look at. Again, depends on everybody's kind of specific fact pattern, but something certainly to consider.
It's a brilliant way to minimize tax and optimize tax over the course of time. Now, you get to retirement. What does Belgium look at for those traditional IRAs and Roth IRAs for distribution?
So under the tax treaty between the US and Belgium, you're going to be taxable on pension or retirement plan distributions in the country of residence at the time of the distribution. So if you're residing in Belgium when you take those distributions out, then Belgium's going to tax them. The joy of being an American is that the US is still going to tax them as well, but you'll get a credit for the taxes that you paid to Belgium on the income. Now, if you, let's say that even if you've been in Belgium the last 25 years, retirement comes, it's time to head back to the US, you retire in the US, and then you take those pension distributions, now they'll be taxable in the US. That applies even if you have a company pension from Belgium and you take that distribution while you're a US resident and you've left Belgium, the US is still going to tax it. And that's that scenario where, you know, over your working career in Belgium, you were probably paying a much higher tax rate in Belgium on your earned wages. And you built up some extra foreign tax credits. Well, you could use those extra foreign tax credits to offset that income when you take the distribution in the US. Because although the US is taxing the income, we're still going to view it as foreign sourced income because you earned it while you were physically working in Belgium. So that makes it foreign sourced. We can use foreign tax credits against that income, and you end up not paying any tax in either Belgium or the US on your pension distributions. So that's always something with that 10-year credit carry forward window. Something I'd always suggest is kind of like 10 years before your retirement date. I realize there's not a lot of unknowns at that point in time, but you kind of want to start thinking about, hey, what's my potential plans? Even if you decide to stay in Belgium, usually when you take a pension distribution, there's several different factors around timing of when you start, what age you are. But Belgium may only tax that pension distribution at 10% or up to 16%. Well, the US is still going to tax it at ordinary income rates. So you could be paying, we'll say, a 25% tax rate. Well, if you're paying 10% in Belgium, the US is taxing you at 25% rate. Well, you get a credit offset on the 10, but the US is going to apply an additional 15%. If you don't have any credit carry forward, that's going to be an actual real tax that you pay to the IRS. If you've got some credit carry forwards that you can use, though, it offsets that extra 15%. And then globally, you get away with only paying 10% on that pension.
Brilliant. It's like you have an answer to everything, Shannon. Josh, do we want to go through some more of these questions?
Absolutely. So Laura Shimikin, I'm sorry if I butchered that. Following up on Andrew's question, does your company provide services to file both US and Belgian tax declarations?
I don't, so I file US tax returns. I personally don't do Belgian tax returns, but I've got a good contact, actually a former Deloitte colleague of mine that I've worked with for a long, long time, that he has now also left Deloitte and kind of runs his own practice within Belgium. And we've teamed very, very closely on those type of things. So we've got several other clients already. He takes care of all the Belgian filings. I handle the US. We've even done it in a scenario where we kind of operate under one engagement letter, and then we figure out the payments between us.
Brilliant. Right. All right. So I wanted to go with a different question. Now, Tebra Page says, if one spouse is Belgian with a green card and the other a US citizen, can the Belgian buy European mutual funds in Belgium without consequences? So if they have a green card.
Okay. Yeah. So the key term in that sentence is green card. If you're a Belgian national and you have a green card, you're automatically treated as a tax resident of the US as well, at least for income tax purposes. Estate and gift tax purposes can be a little bit of a different scenario, but for income tax purposes, having a green card, automatically a US resident taxpayer, both spouses are going to be treated the same. Now, if you're married to a Belgian national, but they do not have a US green card, and you have not made an election to treat them as a US resident in your tax return, then that Belgian national can buy whatever they want mutual funds, any of that type of stuff. And it's at least not going to get subjected to any US rules.
Brilliant. Good to know for sure.
Just keep names off of joint accounts and such for those married couples that have that foreign individual, have that Chinese wall in between the husband and wife.
Yeah. The one thing you do have to watch out a little bit in that scenario is gift taxes.
Mm-hmm.
So the US has a rule that there's unlimited gifting between US citizen spouses. So if both spouses are US citizen, you can give as much money back and forth as you want between each other, and there's no gift tax consequences. For whatever stupid reason, the government doesn't treat non-citizen spouses the same. So gifts from from US citizen spouse to a non-citizen spouse, you're limited to $160,000 a year. It's right in that neighborhood. Above that, it potentially becomes a taxable gift or takes away from your lifetime exemption amount. So the reason I mention that is to be a little bit careful when you're like just changing names on accounts, or it's like, oh, well, I can sell our house and we put it into our joint account, or I put it into my spouse's account. You could have unknowingly just created a gift by doing that, which is potentially a taxable gift. So you got to watch the gift tax stuff when both citizens are not US.
Yeah. Now, just for all of those of us that have less than $12 million, do you want to explain what you mean by that lifetime exemption amount so that everybody's not panicking about gifting money to their spouse?
Okay, sure. So, and this is kind of one problem with Belgium and the US. If you're fortunate enough to have more than $12 million of assets, there is an income tax treaty between the countries. There is a Social Security agreement, but there is no estate or inheritance tax agreement. So you can potentially be subject to gift and inheritance taxes in both the US and Belgium without any double taxation relief. Now that seems scary, but at least from a US perspective, the US still has a lifetime exemption that covers effectively up to about $12 million of assets. That's something that we're going to want to keep an eye on, because I know that Congress has talked about reducing that amount. It used to only be $1 million. Then it went up to $3.5 million, then it was $5 million, and now it's up to 11. There's been talks about reducing it back down to probably that $3.5 to $5 million range. Nothing's been agreed upon that yet from Congress, but it's something we'll want to keep an eye on. But anyway, so in essence, if you're less than 10 million or $12 million of assets, you can transfer assets while living. If it's done while living, that's considered a gift. If it transfers through your estate, then that's called an estate transfer. Effectively, between those two, you can transfer up to 12 million over your lifetime and not incur any gift or estate taxes. Go over that, and then you start paying at a pretty steep rate. I mean, it can be 40 to 45% of your asset that gets transferred, the market value of it.
On that Belgian side, what you have to remember is you either have to go down to the NADEF or you have to pay the transfer tax. If you don't pay the transfer tax, then you have to survive, I believe it's 3 years after the date of the gift, and you will want to have a crummy letter, a letter that basically defines the gift was made on that date for that transaction each time. Otherwise, it will be, again, wrapped right into the estate if you pass away.
Right, definitely a lot of good stuff there. Going back a bit to the FEIE, so if I understand well, you would not be eligible to contribute to an IRA if you use the foreign earned income exclusion to exclude all of your income. But if you made too much money to exclude all of your Belgian income, or if you went with the foreign tax credit instead, it might be possible.
That's correct. That's correct. So yeah, if you've excluded all of your wages, then you end up not being able to make a contribution. But if you did the foreign tax credits instead, or if not all of your wages are excluded and you've still got some supplemental, then you can do the IRA.
So I guess in other words, I don't know, I think the FEIE limit is like 109,000, somewhere around there. So
Yep.
if you make at least 6,000 over that, you could in theory still contribute to an IRA while being on the FEIE.
Yeah. So either you've got to be over that threshold, or you're taking foreign tax credits only.
Gotcha. Okay. If I filed my last tax return using FVIE, can I file an amended return to use tax credits?
You can. So you can either, you can change, you can go from taking the foreign earned income exclusion and you can stop at any time. So you could do it on an amended return, or you could do it on a new return going forward. The one thing you want to be careful of is if you've previously taken the exclusion and then you elect to not take it, there's a 5-year window where you cannot re-choose to use the foreign earned income exclusion. So you, for basically a 5-year period, you kind of lock yourself into not being able to use it. Which if plans are you're staying in Belgium, going to be high tax rate, not a lot of change in your scenario, that may not be a problem, so you can do that. But that's one thing you want to be a little bit careful of is you don't want to say, oh, that's great for me this year, I don't need the exclusion. But if the next year you're going to say, hey, I wish I could take the exclusion, you won't be able to in that scenario if you've elected out. You got to wait 5 years before you can take it again.
Sort of like a cooling off period, I suppose.
Yeah.
Okay. All right, let's keep the questions coming. These are really good. A couple of them I've been holding on to just because I wanted to get as much out of Shannon while we have him here. He's taking a lot of his time, so we appreciate that. Mutual funds, are they the same as index funds? Question for either of you.
No, they are not. So mutual funds typically in the United States have 5 letters in their symbols, and most of them are actively managed. So you can have a few, like Vanguard has some that are index funds, but those are few and far between. Most mutual funds are actively managed, and those are the ones that are problematic, that they don't conform with MiFID. The MiFID rule is only like about a paragraph, and it's subject to interpretation by us and the brokerage firms. In other words, there's no universal country-specific way of interpreting MiFID. It basically says anything that's managed outside of Europe is not conforming with MiFID. I find that pretty easy to be able to say a mutual fund that's regulated by the SEC and only managed in the United States and not regulated in Belgium or any place else in Europe is not MiFID regulated, which is why most of the brokerage channels in America and most of the investment houses in America will say, hey, these are not MiFID eligible. But for instance, American Funds doesn't have that interpretation, but that's because they duly register everything in Luxembourg. So therefore, yeah, it's same as the interpretation that Deloitte came up to on exchange traded funds, using exchange traded funds with those KID statements, but still not as easy as with a passive fund. A lot of exchange traded funds, especially the biggest ones out there, SPY being the S&P 500, is an indexed fund, exchange traded fund. You're just buying into the top 500 companies. That is not a managed product. It is instead buying a packaged product from the United States, and therefore easier to fall out of that MiFID restriction.
Great, awesome. So I want to give Shannon a bit more of a break because I know he was talking for a while. So I'll throw another one your way, Brian. Not so much a question, but still a good one to talk about. When I called Schwab last week, they said we could not purchase US ETFs. Do you know why that might be the case?
That is correct. So Schwab, Fidelity, they're kind of funny in these types of ways, where if you're coming through a professional institution like ours, and there's many others than not just Dunhill Financial, there's many others that are qualified to do this. They will allow you to buy exchange traded funds with your current account. So say you have a Fidelity account, we can actually take over that account and we can manage it for you. You can go ahead and buy ETFs in Belgium. There's other carriers that you don't even need to have that regulation in. We use Premium, we use Trade PMR, which is through the Wells Fargo group, or clears through Wells Fargo group. And they let us buy exchange traded funds directly. Like I said, the MiFID rules are subject to interpretation of the broker dealers. So therefore, what you don't want to be doing is you don't want to be sitting there fighting up that ladder to say, well, this is what I'm supposed to be doing, therefore I'm allowed to, because they're the ones that have to interpret MiFID. If you go through a registered investment advisor, they can all buy ETFs for you there in Belgium.
Right. Okay, so next question. So Mike Friedman says, when could choosing the foreign tax credit instead of the exclusion be problematic?
The scenarios I've seen it it's probably if you would want to use kind of your standard deduction to be able to offset some of your US sourced income. When you're taking foreign tax credits only, you really break it into two buckets. I have foreign sourced income and I have US sourced income. My US sourced income, I'm not going to be able to use any of my credits against. So, let's say, okay, I'm working a job in Belgium, that's going to be all foreign sourced income, assuming that physical services are being done in Belgium. But then I've got a US based investment account, that's going to be US sourced income. Claiming credits only, not going to be able to use any of that credit against that US investment account. Now, the way that kind of ordering works, if you go through a tax return, just the order of it happens is I start with my gross income, I subtract off from that my foreign earned income exclusion, and then after that, I take off my standard deduction. That gets me to taxable income. I calculate my tax, and then I take out my tax credits. Well, the exclusion comes before the standard deduction. So I can have the scenario where I can exclude income, get down to just my US investment income left, and then I can use the standard deduction to offset that US investment income. Well, credits happen a little bit further down in the formula. So if I have, I recognize my income, let's say I'm not taking any exclusion, I subtract off my foreign or my foreign tax credit, or my standard deduction gets allocated. I'm taking that deduction before I get to my credit. So I've essentially allocated some of that standard deduction against both my US sourced income and my foreign sourced income. Well, maybe I didn't have enough and I still have some US sourced income left. Well, now I've got US sourced taxable income that I can take credits against, but I can't use my foreign tax credit. So it's kind of two scenarios where one, I may have been able to offset all of my income in the US by using the exclusion because I could save the standard deduction against it. If I instead take the foreign tax credit method on it, I may actually end up having some residual taxable US income just because of the way that you use the allocation of the standard deduction. Hopefully that kind of makes sense. It kind of gets into
I'm just going to hire you to do my taxes instead.
It gets in the weeds of kind of the ordering of when deductions and credits happen, but that's kind of the main scenario I can see that the exclusion can be better than foreign tax credits.
I love it. Okay, so Shannon, I think we've covered all the questions in the audience. So Josh, thank you for moderating through that. So now we're going to go into the next level of this webinar, which is to get out your crystal ball. So what we're going to need, and we're going to hold you to this, we're recording this Shannon, so we're going to play this back next year for you, and we're going to see what you got right, what you got wrong. What things do you see changing in the tax code?
I don't see them reducing tax rates. I mean, the biggest challenge is getting Congress to agree on something. I mean, at the end of the day, it takes both sides, both the Senate and the House and both sides of the political parties to be able to agree on something. And that's something that the US political system is not very good at right now. So I think the biggest question is if they can actually get something through. The one given in life is that taxes are always going to change. If you look back over history, that's like they never leave it alone. It would be a lot easier to just actually enforce the laws and rules that we have rather than changing them all the time. But the system is what it is. My predictions on kind of what would happen, I think that there was talk about trying to eliminate the step up in basis when assets pass through an estate. I would be surprised that they can get that through.
That was Bernie Sanders' proposal, if I remember correctly.
Yeah. So what happens right now is that so if I make a gift, if I gift an asset while I'm still alive, the donee recipient, there's a carryover of my basis. So let's say real estate is the real common one. It can happen with stock portfolio as well. You know, let's say I have an asset that is currently worth, you know, $500,000, but I originally paid $200,000 for it. So my basis in that's $200,000. I potentially have a $300,000 gain if I were to sell it. If I gift that asset to someone while I'm living, my $200,000 basis is going to transfer over to them. So they still are potentially subject to that $300,000 gain if they were to sell it. If an asset passes through my estate, however, so I pass, you know, I've died, asset goes through my estate and still transfers to that recipient. You get a step up in basis to the current fair market value at the date of death. So in that scenario, let's say that asset was worth $500 or $500,000 when I died. The basis of the recipient is now the full $500,000. So that's what happens when they talk about a step up in basis. There's been discussions about eliminating that. I think there's a lot of pushback, and I'd be surprised if that happens. One, for a couple of reasons. I know that the accounting industry, the CPA industry, pushes back and lobbies very hard against that for kind of a practical issue. You've got assets that people have owned for a really long time when there was no records. There's sometimes people just don't know what their basis in an asset is. If you had received it as a gift from a family member back in the 50s and they had gotten it from, you know, from their grandparents, and this thing goes back 100 years, you've got no idea what your basis is. So that step up in basis kind of serves as a really nice refresh start that we now know what our basis is. It was fair market value at date of death. So that's kind of a practical implication that I know is very heavily lobbied by the accounting industry. I think the other issue is there's just as many wealthy Democrats as there are wealthy Republicans. So that's something that directly impacts the congressional lawmakers as well. Is like if they eliminate that step up in basis, it affects everybody. And I just don't know that they've been willing to go there. Now, something that is more likely to happen is a reduction of the estate tax exemption amount. So again, right now it's about $12 million. I could see that being reduced back down. There's been talks about it, but it probably would land in that $3.5 to $5 million range. And that gets into the political side of things. When it was Democratic presidency before, it was a much lower number. It was under Republican presidents that it got pushed up to $11 million. So that's kind of a political battle that they could potentially look at reducing it back down. Other things that may potentially change, and this wouldn't affect, if you're living in Belgium now, this probably doesn't affect as much, but a few years ago they changed the itemized deduction rules where they put a $10,000 cap on your, they call it the SALT cap. So on your federal tax return, if you itemize, you can claim a deduction for your state and local income taxes paid. So that's like your state income tax liability plus your real estate taxes. Used to be unlimited deduction. So if I paid $100,000 of state income taxes, I got a $100,000 itemized deduction on my federal tax return. They put a cap on that at $10,000. So now, even if I pay $100,000 of state income and real estate taxes, I can only deduct $10,000. That eliminates, kind of adding that in there has pushed a lot more people to the standard deduction rather than itemized deductions. This kind of gets back into the political things, but that created a lot of conflict or anger in the Democratic side, because your high income tax states, which tend to be on the coasts, California, New York, New Jersey, tend to be Democratic states. So I know that there's a lot of push to change that, because at the end of the day, representatives, congressional representatives are representing their population of their districts, and those districts were heavily affected by that SALT limitation. So that's one that I know has been kind of on the chopping block, because they would like to see that go back. And I can see some agreement on that, because in principle, it could actually get passed. The other simple one is just a straight up increase of the tax rates. Right now we've got pretty favorable tax rates. So I can both see ordinary income tax rates increasing beyond Well, two things could happen. Either they increase the highest rate above the current 39% or 37%. It may go back up to like your 39.6, or they can change the brackets right now. And that's kind of the biggest difference between the US and Belgium. You know, if I'm in the US and I'm in the, you know, I could be in the top 37% bracket and I'm paying a high state income tax, you can get into a 50% bracket in the US. And Belgium, you may be paying a 50, you know, it's usually like a 50 to 53% tax rate. The big difference is that the income level that happens at. In Belgium, you're into that top 53% rate by 40,000 euros of income. You get there really, really fast. In the US, you're making, you know, $600,000 of income for a joint filer before you ever get into those top brackets. So they can shift those brackets around. So they may keep the tax rates the same, but it might be a lower income level before you start getting into those tax brackets. Now, I guess the discussions have been is they didn't really want to change anybody making below, you know, $400,000 of income. They kind of want to focus on the higher income levels. But at the end of the day, there's not that many. I mean, it's a small percentage of the population that's actually making those top levels of income anyway. So, you know, that's where they may play around is okay, what is that income level? Where do we shift those brackets at?
Brilliant. Don't worry, I'm not really going to hold you accountable for those, but nothing too controversial in there. And trust me, when it comes to the estate tax, I've spent 20 years telling people, hey, if you ask people, would you rather pay your taxes when you die or when you're living? Everybody's going to say when I die, and I've been completely wrong for 20 years straight. So yours are much more credible than my political and tax views of what we might see in the next year or so. I'd like to kind of veer over.
Brian, one last one I was going to mention. There was talks about eliminating the foreign earned income exclusion. I think that had been in a bill at a point in time. I really don't see that happening though.
Perfect. That'd be
they tend to, what the lawmakers tend to do is they throw in a lot of extra stuff as bargaining chips, which they know right off from the bat are going to get eliminated. But it's basically political negotiating capital. It's like, oh, well, I'll give up this if you'll give up that, when they had the full intention of giving that up from the beginning.
Brilliant. Well, I know the last couple of years have been really tough for a lot of organizations, especially charitable organizations. So I did want to make a quick plug in here and get your input on it. For anybody that's resident in Belgium, they might be able to utilize the King Baudouin Foundation if they want to gift to Belgian organizations that have, because the King Baudouin has a 501(c)(3) in the United States. Shannon will tell you in a second what your deductions will be in the States. But otherwise, there's a lot of great organizations like the Red Cross that are helping out, MSF and such down in the Ukraine, or millions of great charities that you can be helping out that have struggled in the last couple of years. Do you still get the benefits for the charitable deductions on the US side?
Yeah, so a few things on charities. It's kind of a weird rule, but the US, you can only get a charitable tax deduction for contributions made to US organizations, Canada, or Israeli. So if you're giving straight to a Belgian charity, that's generally not going to be a qualified deduction or a qualified charitable contribution for US tax purposes. Belgium may be a different issue, but this is from a US standpoint. If you want the US tax deduction, generally what you want to do is to make the contribution to a US 501(c)(3) organization, and they transfer over the money. So that's kind of spot on with Brian's point. You know, like Red Cross is a pretty common one. They support organizations all over the globe. You make the contribution to the US arm of Red Cross or whatever charity you want to be, and they kind of transfer over the money. That's the direction that you go if you want to be able to get an actual charitable deduction for it. Normally, charitable deductions are considered an itemized deduction. So you're only getting a tax deduction if you actually itemize on your tax return. You're going to itemize if you're paying a large amount of real estate taxes, mortgage interest on a house, and charitable contributions. That's kind of generally the three key ones if you're going to actually be claiming itemized. In 2021, they did allow, so kind of for COVID, in 2020, they allowed a deduction of $300 to charities, even if you were not itemizing. 2021, it was $600 that you could contribute. I actually haven't even seen, I don't know if they've done anything in 2022 yet. At this point, I'm still focusing on 2021 taxes. So they may be, that was kind of a special exception for COVID though. So I don't know that there's going to be anything for 2022.
Brilliant. Now, one nice strategy you were talking about, when you gift, the basis actually carries over. What happens if you gift a stock with a low basis to a charity?
So my viewpoint is on charitable contributions, if it's small things, if you're giving 10 bucks here, 20 bucks here, cash is always the simplest way to go. If you're going to do any type of large charitable contributions, cash is actually about the worst thing that you can give. You want to give a highly appreciated asset. So stock portfolio is kind of always the prime example. The charitable deduction is based upon the fair market value of the asset that you give. So let's say I want to make a $5,000 donation to an organization. If I give them $5,000 of cash, I'm going to get a $5,000 donation, but cash basis is equal, so there wouldn't have been any gain had I converted that. Now, if I've got $5,000 of stock, but my original cost basis of that stock is only $2,000. Well, if I sell that stock as an individual, I'm going to recognize a $3,000 capital gain. I pay taxes on that capital gain. So let's say, that cost me $500. I've got $4,500 left. Well, I've only got $4,500 of cash that I can now give the charitable organization. The cleaner way to do it is just give the charitable organization the stock. If you transfer the stock over to them, you get the deduction for the full $5,000. The charity can sell the stock and liquidate it to cash, but they're not a tax-paying entity, so that they didn't recognize any tax or have to pay any tax on that conversion. So you're a lot better off to give a appreciated asset of some type when you're doing larger contributions. Stock's the simplest one because it's such a liquid asset, but you can do it with real estate, other types of properties as well.
Brilliant. Even if you're not a client of ours and you need help on these types of strategies, we're more than happy to help out in these times of need. We are going to have to wrap it up. We've only got a couple minutes left. So I've got one more commercial to put out there for the American Club of Brussels. Essentially, there's a lot of leadership positions that are available inside of the organization. I know you appreciate these types of events, the time of people like Shannon to be able to give you great information. And we're looking for some people to help out in different areas. So please reach out to info at American Club of Brussels if you'd like to volunteer, if you'd like to maybe look at a board position or anything else in between. But for the rest of you, please make sure to come out and support the organization after a couple of tough years. Shannon, I've got one last important question for you. How do we get in touch with you so that we can actually clarify our personal details with you?
So you can call or email me at any time. And I don't know, Brian, if you circulated in the invite my contact information.
Josh will cover that in a second.
Yep. So Josh, if you want to do that, but feel free to shoot me an email. You can reach out to our website. It's aspire, ASPYR group.com, or give me a call. I am 7 hours behind, but generally always my mornings are typically filled up with calls with Europe. So no problems.
Brilliant. Okay. Well, once again, thank you very much, everyone, for attending our webinar. If you have any questions or would like to get in touch for specific questions, well, you heard the man, and all the respective details of our guest speakers and ourselves will be sent to you after this webinar. So we'll be sending out a follow-up with also we'll have a recording of the webinar put up on our YouTube channel should you wish to review the material further. And aside from that, I think that about does it. So yeah, Brian, Shannon, thanks very much for your time. And Shannon, I hope you have a wonderful morning, I guess it is. And for everybody else, have a lovely rest of your afternoon.
We'll send you some of our rain, Shannon.
Great. All right. Yep. Thanks, everyone.
We'll talk to you soon. All the best.
Okay, bye.
Bye.